Hello, guys. Let's talk about money. If you're tired of feeling like your money is taking control over you instead of the other way around, this video is certainly for you. In today's video, I'm going to talk you through 5 simple but powerful rules to help you take control of your money. These tips are going to be very practical, and these are tips that have actually worked in real time. So if you're new to this channel, I am Yomi. I share content related to finance, investment, and career growth. If this is what interests you, kindly hit the subscribe button, like this post, and let's get started. The very first rules I'm going to be talking about is budgeting. And in budgeting, it's simply a reflection, or it gives a clear picture of how you plan your finances within a certain period. It could be most likely a month, and it kind of give you the direction as to where your money goes to, and provide that guide on what you're spending on, or what you should be spending on, or directing your resources towards. In budgeting, I'm going to quickly share some very important steps that would help you, very practical and real time. The first step is listing everything you spend on. If I'm starting from the scratch, I would say, okay, what do I spend on within a month? I'm going to list them out. Don't attach any numbers to it. Don't attach any costs. Just list all the items: rent or mortgage, bills, water bills, utility bills, car insurance, student loan, everything that applies to your expenses. You list everything out. And just to make sure you're not missing anything out, it's always good to probably check your bank statements so that you are sure you are covering your lists comprehensively. After that, the next thing you would do is to check your bank statement to figure out what you actually spend in each month. Um, Here you're going to be looking at, what do I spend on rent? What do I spend on mortgage? If you're currently on a mortgage, okay, I have a car loan. How much do I spend for car loan? My water bills, how much do I spend? So you're going to give figure attach. You're going to note all that figure out, and the third step is you're going to write down the total money you get in terms of income. It involves your salary. If you're doing a side also, everything that comes in as an income for you at the end of each month, you're going to sum everything together. And fourthly, subtract your total spend from the total income you have at the end of each month. And this gives you a true reflection of your current financial status. Having determined what your financial status is in terms of what I get in at the end of the end of each month, what I spend, total amount I spend at the end of each month. The next thing you will look out into is you try to what categorize your expenditures or your spend into. I have 3 categories I'm going to be sharing. I'm going to call the first one category B, which stands for bills. And for this category, this covers expenditure that if you don't pay them, somebody will certainly knock at your door for such expenses or such money. Those are fixed expenditure, they are non-negotiables, and this includes credit card, mortgage, car loan, student loan, etc. For this money, you really do not have control over this. You just have to pay it at the end of each month. So those categories are called the B, which stands for the bills. Then there's another category of spend, which is the UB. UB simply stands for usage bills. These are bills that fluctuates with your use. Example of such bills, you have water bill, you have light bill, electricity bill. These are bills that, the amount you pay at the end of each month is dependent on what you have used up. Okay, so that's the second category. The third category, I call it C, which is choice. These are flexible spending category. And for this category, it covers spending like eating out, grocery, grooming, and those are expenditures that fall under choice, which is category C. So you will now go to your list that you've written at the beginning. You've attached cost of what you spend each month to them and start grouping all your expenses, attaching B to where B is, U, B, and C, etc. Now, after completing this, you need to ask yourself some questions. One of the questions is, do I have income issues or I have spending issues? I would like to know in the comments at a glance, even before doing this, do you have income issues or do you have spending issues? I would like to see your comments. Drop your comment. Feel free to drop your comment, and I will surely respond. Um, of course, if in most cases you find out that most of your spend falls under the category of B, which is the bills, and UB, which is usage bill, then you come to the realization that you have to find a way to what? Earn more. And on the other hand, if most of your spend are on C categories, then you would know that this category is a category that is flexible, it's very much manageable, it's under your control. Then it's time for you to what? Slash. Let me just share a quick reality and fact. Currently in an era where shopping is just a click away. You're online, probably you're scrolling through TikTok, through Instagram or Facebook. You just see an ad where somebody's advertising certain item, and you're just a click away. Before you know it, you've purchased or bought such item. You walk into your house. As you move around, you can be in your kitchen and you just feel, oh, I need to make my kitchen very aesthetic. I need to buy certain colors of equipment. I need to do this. I need to do that. And before you know it, you're spending and spending out of control. You're spending out of impulse for something you didn't plan for. So, in a nutshell, discipline isn't enough, but automation is crucial to help you keep your finances on track. For example, it's always important to tie your savings to certain value. For example, in my house, in my family, I will just tell the kids, tell the family that for us to go on a family dinner or a mini vacation, you guys need to reduce usage of electricity, and anything we're going to save from those difference across certain period within certain months, we're going to use that money to go have fun, have family time out and all. And over time, I've realized that that has really worked very well. All of a sudden, you see that the lights in the hallway, the lights are always off, and nobody is using the light when it's not supposed to be used. And with that, automatically you just discover that the electricity bill drops, and of course we have a bit of savings to do the family timeout and all. So this is just an example from my own experience. With that, you're not stretching to do these things, but rather saving within, you know, your current expenses to achieve all that. Rule number two is savings. Ideally, it's good for an individual to have four savings accounts. The first one is spending account. The second is bill account. The third is savings one, which is an account that you use for that you use for saving for your investment, and usually it's going to be high yield account. And the fourth one is savings two, which is like your emergency fund account. I see this account as a safety belt, as an account that you have to save for any emergency. Set up these four accounts. The spending account is there, the bills account, the savings one, which is an account that you use to save for investment, you use for long-term goal plan, etc. The savings two focuses on emergency fund. So based on how you've calculated your budget, following the principle we just discussed, apportioning cost based on um, bills, usage bill, and as well as choices. These monies will be distributed to this various account in that order. Everything that has to do with bills goes to the bills account. Everything that has to do with your savings goes to your savings account, the high yield interest, and any percentage you apportion to your emergency goes to that pot in that order. And most times I would advise that you kind of automate your savings such that at the end of each month, this thing just goes to their various pots, various accounts automatically. And from there, the payment goes as well. Um, in terms of savings in your high yield account, it's always advisable to use online banks rather than the normal traditional banks, because for online banks you get good interest rates. Always go for a bank that has financial service corporate scheme, FSCS, and with this bank, you are sure that your savings are secured should in case the financial institution fails or go into bankruptcy. It's important to automate transfer to each of these accounts based on the budget that you have set up. So what it means is when you are swiping to make payment, to buy anything, you are swiping using your spending account, meaning any budget that falls under that category goes to that spending account. You're not spending from your bills, you're not spending from your investment, you're not spending for your emergency fund, you're strictly spending within that pool. And what I would advise is for your bills account, your investment account, you really do not need a debit card for this account, because this is not account you use for your daily spend. So for your daily expenses within the month, all that will be coming from your spending account. That's the only account you should have a credit card for. You've set up this account, you have four accounts, and I just discovered from my own personal experience, I discovered that over time, for like 6 months, I was unable to put any money in my savings account. After I do all the calculations, do all the budgeting, I'll discover that almost nothing, or as little as £2, £5 is what I have left to go into my savings. And let that not discourage you if you're finding yourself in a similar situation. The important thing is your goal, your objective. What do you want to see in the nearest future? And you just have to be intentional about your plans, and gradually you get there. And for my case, and seeing I was having nothing from month 7, it started improving. I was able to get £50. Gradually that increased to 100, gradually 200, 300, and I find myself to a point where I could save as much as 500, into my savings, and all into the two savings account that we just spoke about. So the reason I'm sharing this is for you to understand that You have to start little by little and keep building this over time. I want to share something around paying yourself first. You know, most of us must have heard it before where they'll say, whenever I receive my money, I pay myself first. And I just want to explain a principle that may help you to be able to practically deploy this in your day to day planning, spending, and all. Um, there are four quadrants I'm going to be sharing. One is need, the other is love, like, and want. Now, need it focuses on basic stuff that you can't do away with. One, your rent, your mortgage is basic. Um, your bills are basic, your electricity bill, these are things that are basic things you just have to take care of. Love, which is the second one, is something that gives you joy over a good period of time, let's say a year on over. When you reflect on that, you still feel good and happy. For example, um, going on a vacation, having a special dinner, it's something that you can categorize as something you love. And the third one is like. For like, I see like as something that it gives you that satisfaction, but for a very brief or short period. For instance, I'm going on vacation and I decide to buy lots of clothes to use for this holiday. Fine, it's good. I go for the holiday and come back. And when I get back, these clothes are not things I even want to use. They are not too helpful for me for day to day stuffs and all. So these are short term joy or so, or short term satisfaction, I would say. For such a course, they fall under like. And the last one is want. These are things that are just things we want to do to just satisfy our gratification, just majorly for gratification. They are not basics to our existence, they are not basic to our day to day lives, and etc. So now I would always advise anybody after listing these four items, which is need, love, like, and want, whenever you want to spend or do anything, let's say I'm going online, checking, and I saw anything, and I feel, oh, I want to get this thing, but the first thing that will come to your mind is to think about these four quadrants. This item you're going for, does it fall under need? Is it something you love? Is it something you like? Or is it something that you want? That would help you, to determine how meaningful you are spending. What I'll recommend is for individuals to stick to needs and love whenever you're making decision. With that, you are making a very meaningful spending. Now we're going to look at settings goal for your finances. The ideal standard is for a family or an individual should be able to live on 70% of their income. What it means is the other 30% goes to your savings and investment at the end of each month. And um, there are situations where you find yourself having done the whole calculations of your income, you deduct it from your spend, you realize that you're negative. What it means is some people are living on, let's say, 120%. What this means is you're living on what is higher than even what you earn at the end of each month. Of course, this is a natural situation that happens, but if you find yourself in that situation, it's nothing to panic about. You don't have to panic about that. All you need to do is to come up with a plan. You have to set your goal, you have to set your objective and see how you start reducing that gradually until you get to 70%. 70% can be your minimum benchmark, but over time, you find out that as you become stable, as you tend to increase your stream of income, you will discover that what you're living on will start reducing gradually. from 70 over time. It's a gradual process. It may reduce to 60. You find yourself at 50, 40. Depending on what you earn, you'll now discover that at the end of a month, you're living on, let's say, 30%, 40% of your income. The rule I'm going to be discussing is debt. There are situations where you already have your finances is already in a mess. You have lots of debt. Of course, you still need to find a way to manage this to bring back your finances in order. The first thing you need to do is know your debts. Know your debt in the sense that who am I owing? How much am I owing? What's the interest? When is the due date for each of these amounts I'm owing? You need to do like a mini checklist to list out all this. And through that, you're going to list everybody, every debt you're owing, if it's mortgage, if it's rent, if it's anything, if it's phone deal, anything, car loan, anything, you list them all out. Then, after you've done that, you already brought all your debts in a list. Is create a list of all your debts, and the next thing you'll be thinking of is choosing how you're going to pay this debt off. We share some quick three methods, and this method works depending on individuals, depending on your situation, depends on what you feel is best for you. The first payoff or debt method I'll be sharing is the snowball method. For the snowball method, it's simply a method that allows you to pay off the smallest debt first. Yeah. Here, it's important for people where they seems to want to get a bit of momentum and motivation through the whole process. So paying off a little debt is like a win for that individual. And while you are paying off the small debt, you're not leaving other debts unattended to. What you will be doing is you're going to apportion a minimum amount to each of these um, debts. For example, I have a credit card, I'm owing money, and let's say the minimum amount I'm expected to pay in my credit card, let's say, is £100 as a minimum amount. So what you're going to be doing in this method is while you are apportioning most of your money for paying up your debt to the smallest amount, you're still going to be meeting up with that minimum fee of £100 at the end of each month. With that, it just keeps you, you're not completely leaving any debt unattended to. You're doing the minimum of each of these debt, but of course, you are clearing the smaller ones as at the end of each month. And through this approach, it's great because, of course, if you're an individual that easily feels overwhelmed with debt and you actually need this quick win to motivate you, of course, this method is ideal and perfect for you. So the second method for paying up debt is called Avalanche. And for this method, it's a very logical approach where your focus is on paying off a debt that has the highest interest. It's very logical, it's very efficient, and it will help you save the most on the long run. Um, for you to apply this method, what you need to do is the list of debts you've written, you're going to look at what is the interest attached to each of these debts. Then you're going to rank them, list them on the basis of the topmost that you're going to be prioritizing is the one with the highest percentage in terms of interest. Let's say, for example, you you are owing so much on your credit card, and for your credit card, you're supposed to pay 25% for any extra, for you're going to be repaying at 25%. I have a car loan going for, let's say, 12%, And I also have a mortgage at, let's say, 4% or 3%, depending. So if I'm going to do this ranking using this avalanche method, the first on my list will be my credit card. I would want to see how I I take care of the credit card as soon as possible. While for the others, which is the car loan, the mortgage, what I'll be doing is paying the minimum amount that is expected of me. All other resources will be going to see now I'm going to clear the credit card as soon as possible. With that, you're actually targeting the debt that is going to cost you more on the long run because of course, the percentage attached to it. The third method is the tsunami method. And for this method, it's always important for individual to focus on a debt that stresses you the most. So any debt that puts you through emotional, mental trauma. Those are the debts you're going to be paying off first. So the model is similar to the one we just previously discussed, the avalanche, but in this case, you're going to be ranking your debt on the basis of how it affects you mentally, emotionally, and this method is preferable and ideal for individuals that um, they kind of feel like certain debts are emotionally draining, are really stressful. So if you follow this method, of course, you just be tackling it in that order. In terms of payment approach, it's similar. You're not ignoring others. You're going to be doing minimum for the others in the list. However, or majority of the resources will be going to the one that is top on your ranking, that is really affecting you mentally, emotionally. So this method is also another approach that you can use to manage your debt. Having watched from the beginning to this point, could you drop a comment? Let me know which of this method do you think suits your preference? Which would do you think is your best in terms of choices? Drop your comment. I would happily respond. The fourth rule I'll be sharing is credit score. In credit score, I'll quickly share some things that are very important to have in mind. The first is payment history. Your payment history is very crucial over the years. Have you missed payment? Have you been consistent? Have you been stable? You know, have you been very stable with your loans and pay-ups? So that's very crucial. And I just wanted to add there are lots of people I've heard people say, um, I don't want problem. I'm not going to collect credit card. Credit card is bad, blah, blah, blah. For me, I think credit card isn't bad. You just need to understand the principle on how to manage credit card. Is very good because no credit is equivalent to bad credit. So running away from credit is as good as saying you have a bad credit, in a nutshell. In terms of the second point is credit utilization. The lower your spending using your credit card, the better. Ideally, I always advise people, if you have an approval for credit card, try to spend within the range of 30% or less. Once you're able to maintain that, you're good. The length of credit history is very crucial as well. The older an account, the better you're able to demonstrate stability. For example, I have a car and I have a car, and a brother of mine says, "Okay, I want to drive your car." And this person just got his driver's license, let's say last week, you know, and another of my relative, my auntie, for example, says, I want to drive your car. And this auntie of mine has been driving for over 10 years and no accident history. The one that just got the license last week, into is telling me that I've not had any accident. Realistically, who do you think I'll give my car to? I will comfortably give my car to my auntie because, of course, she has driven for 10 good years, no accident. And this person is just coming in to the driving world. You just got your license last week. I will not be too comfortable giving you my car to drive. That's how the credit score works. It's a principle of the longer you stay in and you're able to maintain good history, then the more stable your credit score is going to be. Um, Another thing that you need to have at the back of your mind when looking at credit score is new credit applications. I've come across people, especially immigrants, where you see people, they'll say, I have 4 credit cards. I collected credit card from these people, I collected from these people, I collected from all within a space of 1 year or less. You're damaging your credit score. It's not advisable to continuously correct credit card from different service provider, as that's going to drastically affect your credit score. Another thing is you have the electoral registration. Being able to register helps to verify identity. So, having looked at all this, I've listed, it's a long list, of course. How do you improve your credit score? It's just a quick one. One, you pay off your credit in full at the end of each month. You automate your bills. All bills, just like we discussed earlier, automate it, and with that, you're not going to be missing any payments and your credit score will drastically improve. The other one is you register to vote. Then keep utilization between 30% or 25% and below. And finally, avoid frequent requests for different credit cards. So if you have been watching this video to this point and you're not yet subscribed to this channel, kindly subscribe, hit the subscribe button, like this post, drop comments. I'll happily respond. Feel free to share your experiences in the comment around savings and everything we've been discussing. I'm going to discuss the fifth rule, which is increase your money. You can continually slash or cut your choices, adjust your budget within each month, but you need to get to a point where you need to earn more to really boost your financial situation. Just a quick question I would like to ask is what side hustle could you start today with the current skills you have? Please feel free to drop it in the comment. Um, I would happily and love to really hear from you guys. The other thing is how do you increase your money? One is look at side hustles, and I would just want to start by telling you that the first thing you do if you're going to start any side hustle, even though you feel you want to start babysitting as a side hustle, you want to start baking, etc., you need to focus on doing the mathematics to say, okay, what am I going to invest into this side hustle? And I would advise you focus on direct return in investment. Let me give an example. For instance, if I'm a baker and I know how to bake cake very well, but I don't know how to decorate cakes to look beautiful. I bake cake, I sell cake, and I feel okay. What do I do to upskill, for example? And I now feel okay. Let me go register for a class where I'm going to learn how to decorate cake. I think for me, that's a good decision because, of course, you may pay, let's say, £200, £300, £400 to learn how to decorate cake. And indirectly, that translates to increase in price for cakes that are decorated. Meaning, if you're selling a cake at certain amount, because now you have learned how to decorate it, you have acquired extra skills, and you decorate this cake, that will just automatically increase the price of the cake you're selling. That's what I mean by direct return in investment. Let me quickly share another indirect one, probably to make it a bit practical in terms of indirect return in investment. Imagine I'm starting a business, my cake business, and I decided that, oh, I want to go and open a website. This website can come later because the website is not going to give me anything. I can't really get any immediate impact of the website on my business, unlike going to learn decoration, or it could be acquiring certification on something that would add more quality to what you do and you get more pay. Okay, so setting up a website, good to have, but that's something that can come later, dealing with branding and etc. Now, the focus is looking at what would translate to immediate change in your skills, in what you are delivering, and immediately you can recover that cost back. So that's for business and as a side hustle and all. If, for instance, you're working somewhere and you feel you need to increase your money, there are options to explore. For example, if you're working in a company and over time, it's always good to note how much money, how much value, how much impact you're bringing to the company. You have to quantify it. Are you able to bring in certain amount of money? Are you going to be able to increase sales in certain area? And with all these facts, you can go on Glassdoor, check for your similar role, what are people being paid? And of course, mind you, there's no way that all companies can pay the same. So you need to check to look at the size of the company you're looking at, the size of the compared to the size of the company you're currently working with, to be sure that there is this a bit of match in terms of sectors and other things. With all those at hand, when you have reviews with your line manager, you can bring out facts to negotiate for a pay rise. At that point, you're not even looking at a pay rise. I call it correction of salary. And through that discussion, you can get extra 2%, 3% top up on your salary, and you're good to go. So those are just very simple ways you could increase your money. And kindly let me know in the comment, are there other ways, other examples that you've used that helped you increase your income? It could be freelancing, it could be anything. Feel free to drop it in the comment. So finally, managing money is not about perfection, but it's mostly about interest. You have to start small, you have to automate, you have to track what matters. You have to find a way to see how you apply these 5 rules I've just shared in your day to day planning of your finances. And finally, I would say let your money reflect your values and not your impulses. So kindly tell me, which of these 5 rules do you need to focus more on right now? Drop your comment. And please like this video, subscribe to my channel, and watch out for my next video. Thank you for watching, and bye bye.